If you own Canadian bank stocks, this is going to be a video that you want to watch in its entirety. S&P Global put out a great report on the potential impact of tariffs for Canadian bank stocks. And there's a bit of confusing terminology in this report. It's quite comprehensive. It goes in quite a bit in depth. So I'm going to break it down for everybody into easy, digestible chunks so that you can get an idea of what S&P Global thinks will happen to the Canadian banks in light of tariffs, especially if they last a long time. As always, everybody, before I get started, 3 of my top stocks for 2025. There's a report in the description. You can grab that absolutely free, and you'll also be added to our newsletter that we send every Monday. Absolutely free newsletter covering market commentary, investing strategies, stock research, ETF research, anything you can think of. Over 25,000 Canadians get it every week, and it is helping them become better investors. But let's dive right into the report. So this report was published on March 12th, and what it says is, on March 4th, 2025, the U.S. administration imposed a 25% tariff on Canadian goods imported to the U.S. and a 10% tariff on energy and critical minerals before providing temporary relief until April 2nd. So the ultimate impact on Canadian domestically systematically important banks. So what exactly is a DSIB? It is pretty much a bank that, if it were to get into any financial trouble, it would have a material impact on the Canadian economy. So a domestically systematically important bank that fails or experiences distress could disrupt Canada's financial system and economy. So when we think of banks like this, we're thinking of pretty much the big 6, CIBC, Bank of Montreal, Toronto Dominion, Royal Bank, things like that. However, when we look to the really big banks, we're talking Royal Bank and Toronto Dominion Bank, they are actually GSIB, global systematically important banks. And if we look to the list of GSIBs, you're going to see JP Morgan, you're going to see Citigroup, HSBC in the UK, you're going to see the Agricultural Bank of China, Bank of America, but hidden down here, you're going to see Toronto Dominion and Royal Bank of Canada. These are the 2 globally systematically important banks. So CIBC, Scotiabank, Bank of Montreal, they aren't quite big enough to hit that benchmark. But the one thing you need to take from this article is all of them have huge influence on the Canadian economy. So what does S&P Global believe? They believe that these banks, despite them having strong balance sheets, diverse loan books, and varied revenue sources, which should help offset the impact of tariffs, a prolonged duration would generate headwinds for banks' credit quality and profitability. So they still view their outlooks as stable, but they're definitely kind of, I wouldn't necessarily say sounding the alarm, but definitely sounding a bit of caution when it comes to banks. And I'll get to the overall impact at the end of the video, so you are going to want to watch it all the way through. But when we go to this first chart here, we're looking at the top 10 industries which could potentially be hit by tariffs. Now, what this chart does, this bottom portion here is a percentage. So we're looking at 0% on the left-hand side of the chart, and we're looking at 16% on the right-hand side of the chart. And then we see all these different industries. So we're looking at a range. So S&P Global is effectively assigning the range of how badly something could potentially be hit by prolonged tariffs. Now, when we look to total GDP, it's kind of hard to guess where this is. I mean, I'm guessing this is about 0.75% up to about 2%, it looks like. And that is effectively what they're saying the total GDP in 2025 could be potentially hit by tariffs. And when we look to the largest impacted areas, we're looking at paper products and printing. Like, we're looking at probably 8.25% to 15.75% decrease in output. This is huge. There is no doubt that this area is going to be hit relatively hard. When we look to wood production, we're looking at anywhere from probably a 4.5% to 8.5% decline. Electrical equipment, we're looking at 3.25% to probably 5.25%, 5.5%. And when we look to metals, we're looking at anywhere from 3.5% to 7.5%. So this is a very good chart that can kind of give you an indicator of what industries are expected to be hit the hardest. Now, when we come down here, Canadian banks' revenue and loan diversity and earnings power provides buffers. There's absolutely no question the Canadian banks are protected heavily here due to regulations. It is very hard to have any sort of competition enter the market. I know they had mentioned that a lot of US banks operate here with, I believe they said like 100, I believe Trudeau said 115 billion or so in assets under management. That's an absolute drop in the bucket. Even if we look to a bank like CIBC, which is one of these smaller ones, excluding National, I believe they have like 350 billion in assets under management. So there is very, very little competition here when it comes to the ability for Canadian banks, major banks, to lose market share. So pretty much what they're saying here, as of the first quarter of 2025, commercial and corporate loans accounted for 32% of total loans and are further diversified by sector, many of which are directly not affected by tariffs. So they pretty much say on the commercial side of things, this diversification should support credit quality and possibly, mitigate higher allowances and higher provisions. However, they do mention in a prolonged scenario where the Canadian economy slows meaningfully and unemployment rises, secondary effects will likely hit other commercial sectors as well as retail lending, particularly unsecured consumer lending. So that would be, lines of credit, things like that, not necessarily mortgages. And when we look to the banks overall, we can see that residential real estate loans are a huge chunk of their portfolio. In fact, pretty much every single Canadian bank, the majority of their lending portfolio is going to be residential real estate loans. We look at 41%. Whereas commercial and corporate loans, 32%, commercial real estate loans, 9%, and other consumable loans, 18%. So if we think about a weaker economy, higher unemployment, things like that, yes, it's going to hit these commercial and corporate loans, but I would say the area that is going to be hit hardest would be these residential real estate loans, because often, people are unemployed, they can't pay their mortgage. And when we look to these other consumer loans, like these unsecured type loans, they're going to probably prioritize higher necessity debt, I would say. Let's say a vehicle payment or a mortgage over something like a, unsecured line of credit. So those could face a lot of pressure as well. But pretty much what S&P is saying here is as tariffs linger, there will no doubt be larger impacts. Effectively, we need them to go away and we need them to go quickly. I know I've always spoke about how lots of these banks have international exposure, at least some of them. However, they do still have massive Canadian exposure. So we're looking at Canadian loans as a percentage of total loans consolidated for the big six banks is high at 70%. So they do believe that they expect the Canadian economy will be hit harder. The U.S. economy is not immune to the fallout from tariffs. And when we think of banks like TD and BMO, they have the highest exposure. Now, this is a very important chart here. So we're looking at Canadian loan exposure of those domestically important banks as a percentage of total loans. So we look at total. We're looking at National Bank. Looks to be around 88%. We look at CIBC, they're 80%. We look at Royal, they're around 78%. We look at Bank of Nova Scotia, just under 70%. TD, 65%. And then we look at BMO, which has the lowest exposure to the Canadian market, which is actually what has kind of hit their results so much recently, just because of how well the Canadian market has done, how resilient it has been. But they're sitting at around 58%. But the one thing that is very important to know here is that retail exposure. We look to National Bank of Canada. They have relatively low, in fact, the second lowest exposure to retail loans. So we're looking at 45%-ish, whereas we look to a bank like CIBC, which I've often mentioned is the highest exposure in terms of Canadian retail loans, whether it be mortgages, whether it be lines of credit, things like that. We're looking at over 60%. Royal Bank sits in the high 50% range. We're looking at Bank of Nova Scotia just at 50%. We're looking at TD just under 50. And then obviously Royal Bank, again, they have low Canadian exposure relative to the other institutions. So in terms of Canadian retail loans, they only sit at around 35%. So you're looking at a heavy Canadian exposure bank like CIBC at 60, whereas BMO is around 35%. So if you own these banks, it is very important to get an idea of how exposed you are to particular segments in Canada. I know there's a lot of talk about how the banks, they'll never fail. They've paid dividends for hundreds of years, this and that. That still does not mean you don't need to understand what you own, because to be honest, we are in an environment that is just absolutely unprecedented. We're talking about the largest deployment of tariffs and the most aggressive deployment of tariffs by the United States since effectively the Second World War, which, if you look to that data, the tariffs didn't necessarily cause the Great Depression, but they definitely accelerated the impacts of it. It didn't work back then. It probably won't work now. But that does not mean that they won't aggressively attempt it. And if they do, the Canadian economy will be hit hard, and you need to understand your bank exposure overall. So the next portion here would be effectively their diversified revenue. So Canadian banks benefit from meaningful revenue diversity generated by various business segments. So we got personal, commercial, wealth management, corporate banking, capital markets. They are relatively balanced between net interest income and fee revenue sources. So when we look to this chart, National Bank has the lowest exposure to non-interest income. So effectively what interest income would be is the bank taking deposits, loaning them out. That's spread on those deposits. They earn money off that. So we're talking mortgages, personal loans, credit cards, line of credits, all that type of stuff. Whereas non-interest income is something the banks earn from, say, fees, commissions, other financial services that aren't necessarily related to lending. So we can think of things like banking fees, trading and investment income. We can think of credit card fees. We can think of insurance products. We can think of stuff like underwriting, investment banking, things like that. So the non-interest income will likely be impacted less than the net interest income, because obviously in a slower economy, less people start borrowing, things like that. And ultimately in a declining rate environment, this net interest income is going to be impacted as well. This is another great chart here to highlight Canadian revenue versus total revenue. We look to banks like National Bank and CIBC. National has the highest exposure to Canadian revenue as a percent of total revenue. We're looking at, it looks 73%. CIBC looks to be in the high 60% range, and then it continues to go down. Obviously, we have BMO and Bank of Nova Scotia at the lowest. Bank of Nova Scotia has a lot of international exposure, which has not worked out for them very well whatsoever. And obviously we have BMO here with the least amount. So the one thing I do find interesting here is S&P Global believes that banks with larger capital markets businesses should have an advantage. That's because greater volatility from unsettled market conditions could result in more trading activity, which would be a tailwind to trading revenues. And also because of these banks' investment banking activity is based on business outside of Canada. Now, another thing they say is we think some of the revenue headwinds from these businesses in Canada could be offset by increasing loans in the US. And in regards to this, you're going to see banks like BMO likely have the best exposure in that regard. So the next thing they talk about is credit quality and provisions. So when we look to provisions, especially when we look to total allowances and total provisions in terms of gross loans, we can now see that we are above pre-pandemic levels on both a PCL and an ACL basis. So this ultimately is not really a good sign. I mean, the economy is in a much worse situation than it was back in 2019. Obviously, this short spike due to the pandemic was, there was a lot of recoveries in this regard because they really didn't know what was going to happen. But this is going to be something you're going to want to keep a very, very keen eye on here is rising provisions. This is one of the most important aspects of the bank, and I would say there's a very, very good chance these continue to accelerate upwards. And effectively, S&P Global thinks the same thing. We think large Canadian banks will need to resume building their allowances. So There was kind of a flatlining period in 2024 where provisions started to come downwards, and that kind of sheltered the Canadian banks. But now, with these tariffs, they're likely to accelerate again, which ultimately will impact earnings. So pretty much they expect the tariffs will hit bank profits. This isn't really all that surprising, but they mentioned in a longer duration tariff scenario, we expect that banks' profits could be dampened or even reduced through lower net interest income from shrinking loan growth, lower fee revenues, and higher provisions for credit losses. But they also do mention, and this is going to be the final thing I go over, in our revised base case, the stress should be manageable. The Canadian banks, they're very well capitalized. They should be able to withstand a lot of economic turmoil. They are structured this way, and regulations are put in place to ensure this. Now, the one thing of particular importance in their new revisions is that they do not include any possible offsets from the Canadian government. We could see a multitude of counter tariffs in terms of the Canadian government on the US if they continue to put pressure in regards to this trade war. I mean, just off the top of my head, I can think of possible increase in energy tariffs. I can think of a possible increase in, say, potash. We do supply a lot of potash to the United States, which is a huge thing when it comes to agriculture, stuff like that. But there's really nothing certain we can take from right now, so it's very hard for them to project it. But what they do say in their new base case, they expect flat revenue growth year over year in 2025 as loan volumes increase only modestly compared with our previous projection of 6% growth. So this is quite a big downgrade. Mid-single digit loan growth down to flat loan growth is that's a huge downgrade. And in addition to this, their base case also assumes strain on fee income from banks, wealth management, and investment banking businesses, which, I mean, this is completely reasonable. When you think about it, the markets are not going through a good bit right now. We got the S&P 500 in correction territory. We got the NASDAQ in correction territory. Ultimately, this no doubt would hit that area of the market as well. They effectively believe that the banks will rein in expense growth in order to offset the revenue pressures. And again, I've mentioned this numerous times, provisions for credit losses are the biggest wild card. And we believe banks will likely increase the probability of a recession in their projections. It's difficult to tell what extent. If they are predicting a recession, they will raise provisions for credit losses. There is almost zero doubt. So they effectively think that provisions for loan losses as a percentage of average gross loans will come in above 50 basis points. I believe this is an average among all the banks. So previously they had been mid 40 basis points. And they do believe that the bulk of the increase would be coming from higher performing provisions and not impaired provisions. So those are loans that are being paid right now but are expected have a good chance of going unpaid in the future. And finally, they expect that net income can fall from 2024 levels with a return on equity between 8 and 11%. So this would be a decline for most banks in terms of return on equity. I mean, I know Royal Bank is much higher than that. I know some of the lagging banks like Bank of Nova Scotia, things like that, their return on equities are lower than that. But ultimately, it was effectively a downgrade across the board. And this chart will kind of give you an idea of what they expect now. This is a relatively small downgrade. I mean, when we look to net interest income and non-interest income, we can see a very small tick here. Revenue declines single digits, same with expenses. Provisions obviously expected to rise, and then we see net profits are expected to fall. Profits probably have the biggest, revenue and profits, I guess, have the biggest impact in this chart. Now, the one final thing I want to go over is this potential countermeasures from the federal government. So our stress scenario does not incorporate any potential benefit from the Canadian government, which we believe could step in to provide targeted relief to businesses hit by tariffs. Obviously, if the government comes in and provides relief, we're talking, like a similar situation to COVID, where they maybe help businesses out. Let's say those lumber companies, the automobile sector that has been hit materially by tariffs, they might provide some relief to some of the businesses, some of the consumers, and ultimately that could take a little bit of pressure off. I mean, in the end, you end up with a whole slew of other issues when you start deploying capital at a wide scale rate like we did during COVID-19. But The ultimate impact here in terms of the consumer and the businesses is it would provide relief, which would probably take a bit of pressure off the banks. Overall, everybody, I hope you like this video. This is an amazing report. I'm going to drop a link in the description to it. You can read the whole thing. It goes very in-depth and very neutral analysis on the Canadian banks. A lot of people love Canadian banks. There is no doubt about it. But again, we are in an environment that we pretty much have not seen for a very, very long time. Who knows what's going to happen? I ended up trimming a lot of my Canadian banks at the end of 2024 just because valuations got a bit high. I still do hold them, but they only make up around 6% of my portfolio, National, Equitable, and Royal Bank. And I do believe, I've known a ton of investors that have, 20+% of their portfolio in these banks. And although I never believe they will get into financial distress to the point of them being materially impacted, there definitely could be a lot of headwinds here for the Canadian economy. And it could be a reasonably rough ride for banks moving forward, and you need to make sure you are properly allocated and not over allocated to these banks. Now, what that allocation may be highly depends on your risk tolerance, but I know way too many people who are hyper concentrated in these banks, and we're entering an environment that we just have not seen before, and you need to be at least taking this into consideration. Obviously, I'm not going to tell you how to invest, but you need to take something like this into consideration. Read this article, see the overall impacts, understand more about what you own, their overall exposure, things like that, and it's probably going to help you not only give you a bit more clarity, not only help you in the event something material would happen to the Canadian economy, but just overall, something like this to help you understand these businesses a little bit more because they are very, very complex. So that's it for the video, everybody. Hope you liked it. Head down below, subscribe to the channel, like the video, drop a comment, and also grab that report on my 3 favorite options for 2025. It's absolutely free in the description below, and stay tuned for more great investing content.